I just want to introduce myself. So my name is Regan Carlo. I am VP of Operations over here at Metco Credit Union, just across the railroad tracks on 8th Avenue. Hopefully some of you have attended some of the seminars before. We missed out on all of last year, so we wanted to get this started as quickly as possible. So I thank all of you for joining us. And I say us, I'm also have Becky Zemlicka, who is my Zoom expert to help me get through all of these webinars. But then she is also our moderator, so she's going to help us with the questions. If you have any questions, please don't hesitate to use the chat feature at the bottom. She'll be able to monitor those and make sure that we get those asked. So thank you. Thank you all for joining us. I'm excited. So I know last year was last year. That's really how I'm going to kind of leave it. But one of the things I learned a lot about the lending process and kind of what I wish as a borrower people could know. So what is it that I can share with everybody? And that's really what I came up with for this topic. What does as low as really mean? So when it comes to interest rates, you know, how do we get the interest rate that is advertised? So we're going to dig into that, but real quick, just a couple housekeeping things. There is the raise hand feature that everybody has. So if you all want to just test that out real quick, make sure that comes across. Again, Becky's going to help me monitor that. So if she can see all raise hands, that will work. You can ask a question that way. So I'll give it just a minute for everybody to kind of test out that feature, make sure it all works.
I see them starting to come through.
Perfect.
Yeah, so it's right down at the bottom of your screen. It should say raise hand. All right, yep, they're coming through. I think we're good.
Okay, wonderful. Thank you. There's also that chat feature. So just to kind of test that out, I'd love to hear what everybody thinks, or what do you like most about spring? So like I told the other group, today's not a true test of spring. I mean, I guess maybe it is because it's raining and kind of gloomy, but what do you like most now that we have hit spring? So type up your answers in the chat feature, and then we'll get some of the answers shared.
Yeah, so planting my garden, getting outside. Warmer weather and green stuff growing. Spending time outdoors, absolutely. Being able to open the windows, sitting on my deck. The smell of fresh cut grass, as long as you don't have to cut it, right? Getting new siding after the Durate show.
Yes, all great answers. I'm going to take my kayak out as soon as I can.
Oh. And I did have someone ask as well, will the slides be available? I did send an email out with the slides, but I will get that out to you. So if anyone needs that email, let me know and I will send that to you as well.
Well, perfect. So thank you, Becky. Thank you, everyone, for participating. We're going to dive right in just so we can stay on schedule. So many of us over the last year have heard about the record low interest rates, low rate environment that we're in. And everybody, it appears, all financials are trying to encourage us to either buy or refinance a home, or maybe it's buy a vehicle. We hear these kind of day in, day out. They're on the radio, they're on the TV, everywhere. So please click on the raise hand button if you've ever followed the advice to buy or refinance, only to learn that you didn't quite qualify for that as low as rate that was advertised. I'm not going to raise my hand on the screen, but I'll raise my hand here so that y'all can see it, that we're not alone. I think there's a lot of us out there.
Yeah, I'm definitely seeing some raised hands.
Yes. So how can I help with everybody, educate kind of what that means? Where do we go from here? That's the purpose really of today's seminar. So these are the top 3 things that I want to help. I want to explain how interest rates are determined for a loan. I want to share how you can qualify for the as low as rate. And then I also want to share how we can better understand why it's a good thing not everybody qualifies for the same as low as rate. All right, we're going to do a real quick roll call. Becky, if I could have your help, if there's anybody that we're missing real quick, I just want to make sure everybody gets the credit for being here today.
Yeah, I do have a few people I want to check and see if they're on the call. Man, I'm sorry if I butcher your name. Kola Iben, E-I-B-E-N. Are you on here? Janine Shreestha and Cindy Yoder. And then Dawn, is it Froese? F-R-O-E-S-E. Any of those on the call? Oh, I see she's not here today. Okay. All right. I think everybody else I have.
Okay, perfect. Thank you. Okay, so I'm going to give some underwriting secrets throughout today. I call them secrets just because on the financial side of things, I think we know all this. It's part of our job on a daily basis, but they're secret because not a lot of these are shared with the true borrower. So financial institutions use a process that's called risk-based lending to determine the rates that are offered to borrowers. This is the practice of charging interest based upon specific factors and tiers. So there's tiers that you can qualify for. And each institution is going to create their own specific factors that determine the borrower's rate, but we all use the same guidelines. So the bottom line is that not all borrowers will qualify for that as low as rate. But let's see how your rate is determined. So we take a look at and evaluate what a borrower's probability to default on a loan is. That default is actually the risk. So the higher the risk to default or make a late loan payment equals a higher interest rate. So why, you may wonder and ask yourself, so why do financial institutions advertise the as low as rate if not everybody qualifies for that? Well, in reality, it's to remain competitive. So if Bank A or Credit Union A down the street is offering 3% on a car loans, but Credit Union B down the street is offering 5%, you're going to have the public and even their members or clients go to where that interest rate is. So you'll see very similar rates across the board. And that is, we do comparatives with others just to make sure that our interest rates are in line with what our market is doing. It's to remain competitive. So loans are the primary way that financial institutions make their money. We charge the borrower interest on what the money is that they borrow, and interest equals income. So that's kind of a short version of how a financial institution makes their money. So why is risk-based lending good for everyone? This is the one thing that I want everybody to kind of take away, that this is a good thing. It truly is good. This risk-based lending allows lenders to lend money to more people. So without it, lenders would only be able to offer loans to people that met very specific criteria. So maybe the criteria is you have to have a 740 credit score, or we can't give you money. We can't help you buy that house. We can't help you buy that car. But with risk-based lending, now we can offer to more people, and we might have a little bit of a higher rate just because that risk is a little higher. However, we can get people into homes and vehicles and buy things that they need to live. So it allows people who traditionally couldn't get a loan to now borrow and be able to qualify for a loan. It might be with a higher rate, But people with stronger credit scores and stronger credit histories will receive that lower rate. There's less risk. Oops, I think I went too far. Okay, so as a consumer, what do you need to look out for? What do we need to look out for? So bait and switch, you may have heard of this. This is the practice of where consumers are being baited by merchants advertising products and services at a low price. But then once we are with the merchant, we discover that the advertised price is not available to us. So really, you might think that this falls in line with what financial institutions are doing with their as low as rate when we advertise that. However, have you ever seen the fine print underneath either a brochure, or maybe it's on a poster in the lobby? Maybe you're seeing something underneath, super small fine print. That's where we're required to disclose the rate requirements or how you qualify to get that rate. So all of those have to have that small disclosure at the bottom. So as a consumer, please read that. That will give you the information that you need to see if you qualify for that as low as rate. Think of the commercials, I think of like prescription drugs. The guy at the end is talking super fast and you can't understand what he's saying. That's really what this is. It's reading the fine print. Okay, so I want to dig into the underwriting secrets of mortgage loans. So how do you qualify for the lowest rate, or what do lenders look for when determining interest rates on mortgages? On average, they take a look at the credit score. So they want to see that credit score of 740 or higher. And this is going to be on all three credit bureaus. I should note that too. There's 3 different bureaus. They take the middle score between all 3 of them, and they want to see the 740 or higher. Loan to value percentage. So the definition of loan to value is a measurement of the relationship between the loan amount and the market value of the asset securing the loan. So think of this as the amount that you're borrowing, or the loan amount, and the value of your home. So they want to see this at 75% or higher. I should note too that a lot of times you hear that 20% down or 80% loan to value. For mortgages, as long as you have 20% down, you don't have to pay what is called the private mortgage insurance, or the PMI, but that piece of it doesn't quite qualify you for the lowest rate. They want to see 75% loan to value. So an example of that, we like round numbers, it's easy math. You buy a home that's appraised at $100,000. You make a $25,000 cash down payment. That means that you will borrow, or the loan amount is $75,000. This results in an LTV ratio, which LTV is loan to value, of 75%. Okay, next up, more secrets. So they want to qualify you for the lowest rate, if it's a purchase versus a refinance. So you're going to get a better rate today on a purchase than if you refinance today. They also look at the time with your current employer. How long have you been at your job? They want to see the longer the better. That is stability in your income. The longer you're with an employer, the longer you have that stability. They also look at the overall financial stability, or your financial character. This is based on your credit histories and your payment history on your credit report. Debt to income percentage. This is another mathematical equation, but they want to see that your debt to income percentage is 30% or lower. And we're going to figure out on the next slide how we determine what that is for you.
Reagan, can I interrupt you for just 1 second?
Absolutely.
Looks like we might have a question. Kathy, do you have a question for us?
I was curious if, when you were talking about 25% down for every 100,000 for a mortgage.
Oh.
would your equity, like when you sell your previous home, does that count? Is that
Yes.
okay? So not cash, but just, well, I guess it would be cash, but
Yeah. Yep.
Okay.
So when it's all said and done, if you're using the equity that you've built, or what I would say would be proceeds from the sale of your house, you're going to use that and basically transfer it to the new one. It's still considered cash. So yep, it'll go towards that 25% down equity. Good question. Any others before I move on?
Not that I see. Nope.
Okay, so let's figure out debt to income. So again, this is just going to be round numbers, makes it easy for everybody, myself included. So how do we figure out what our debt to income ratio is? So let's say that we have a mortgage payment of $1,500 a month. We have a car loan payment of $100 a month. And maybe we've got a couple credit cards and a personal loan that equal out to be $400 a month. So adding these up, we have $2,000 of monthly debt payments. Now, your mortgage can also be rent. So let's say that you're renting currently. We take a look at what your housing expenses per month. So you can replace mortgage with rent. So the $2,000 also does not include like your utility payments, cell phone bills, insurance. It doesn't include those within their monthly debt payments. So let's take the example that you bring home $6,000 of gross monthly income. So this is before taxes are taken out or before health insurance is taken out. You take your $2,000 payments divided by your $6,000 income, and your debt to income ratio is 33%. So you're darn close to that 30% that mortgage lenders want to see to get the best rate. Okay, so here's the good news. Those are all the ways that you can get the best rate with all those combinations combined. So as long as you can mark off each and every one of those, there should be no reason that you shouldn't qualify for the best interest rate on a mortgage. However, let's say you hit one of those, but not all of them, or maybe you're real close to hitting all of those. You can still qualify for a mortgage, and here's how. So mortgage loans, you can have a credit score as low as an 580. As long as your bankruptcy has been discharged within 2 years. So if my bankruptcy were to discharge tomorrow, or 2 years ago tomorrow, I can apply for a mortgage. Collection accounts. So collection accounts are those possibly medical collections. So maybe it's a past medical procedure that you had, you lost the bill, you moved, and now they've put it over into collections. Those all must be paid prior to receiving a pre-approval. That doesn't mean that if you have one or you find out about one, you can still take care of it before that mortgage is pre-approved. So if you apply for it, find out about a collection accounts, they will just require that you pay that off and have proof before moving forward. Loan to value percentage may be as high as 96.5%. So prior slide, we talked about 75%. You can go as high as 96.5%. On the flip side, what that means is it means a 3.5% cash down payment of the purchase price. Now, there's always some exceptions. So there's always that gray area. So some of those exceptions might be, you may be able to have 100% financing, and that has to do with the way that your financial institution will actually structure the loan or loans. There's likely going to be two, but please, 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 if they offer this solution or option, find out exactly what that means. A lot of times if they structure it, one of the loans might be interest only. for 5 years or so. You may not actually make a dent in that principal, and then you have to refinance it after a certain period of time. So please read the fine print, ask questions, be curious. But there are always some exceptions. Now, if you're also looking to refinance versus purchase, because it is a low rate environment, expect on average about a 20 or a quarter of a percent or 0.25% higher than that as low as rate. So purchases have a lower rate than a refinance. Also, on a similar note, if you have an investment or a rental property, or maybe you have a vacation home, if any property that is not your primary residence, you want to refinance that mortgage, expect on average about 1% higher than that as low as rate that they're offering. This is primarily due to the fact that it's not your primary residence and you're not living in the home the majority of the time. It's something extra, if you will. You can still qualify for a mortgage if your debt to income percentage is 43% or lower. So that's the max. So you can kind of work backwards, take your gross monthly income and find out what 43% of that is. And that is the max amount that you can have outgoing in payments every month for credit cards, loans, mortgages, all of that. And then again, they want to see 2 years of verifiable income. So maybe you've worked at your job for 1 year, but prior to that, you had another employer. As long as there's no lapse in job time and you've had verifiable income for 2 years, you can qualify for a mortgage.
Reagan, I have a question here. The bullet where it talks about if you're refinancing, expect a higher rate than the as low as. Why is that? Why is there a discrepancy between purchase and refi?
Yeah, that's a good question. So this was something that I actually learned about last year. And it was news to me, but I think a lot of it comes with there's more risk involved potentially on a refinance. So maybe you're going, because rates are so low, you have a 30-year mortgage and you want to go down to a 15. So you might actually lower your interest rate, but increase your monthly payment. Or maybe you are doing a cash out refinance. So maybe you want to do some work to the home and you want to take some of that equity out. So now you're actually going to increase your loan amount and increase your payment. I would say there's a lot of different factors, but I think going in knowing that a refinance is going to be a little bit higher than what you're seeing in big, bold numbers, I think is smart. It'll help. Good question.
Yeah, and it looks like we have a question from Becky Shoup as well. Becky, do you want to unmute and ask your question?
Yep, Reagan, you said you didn't want to see a break in people's employment. Is there any consideration, it doesn't apply to me, but is there any consideration being made for people that lost their jobs due to the pandemic? I know my daughter-in-law's primary job was booking conferences, airlines, hotels. She literally lost her job for like 8 months. Is anybody, is that being under consideration at all?
Yes, there is. So as long as you can, I think a lot of times they'll go back to the employer that either, you know, if you lost your job completely, but were eligible for state unemployment,
Right.
That's taken into consideration as well. They may go back to that employer and find out reasons as to why they either had to let you go or did let you go. So as long as those are, I would say any lapse in employment is verifiable or
Right.
you know, you can find out information on. So yes, there are still things that can be done.
Okay, thanks.
Yeah, good question. Okay. Okay, so here's a little bit about what minimum credit scores are available for the different type of mortgage loans that are also available. So there are FHA mortgages. These are federal housing administration loans. Minimum credit score is a 580 with at least a 3.5% cash down payment, or as low as a 500 with a 10% cash down payment. So this kind of goes along with that risk as well. So the lower the score, they're going to require more of a cash down payment, more equity in it. FHA loans are intended for home buyers with low to moderate income. However, you can also apply. There's not a set dollar amount for income. There's just, I would say there's a little bit more qualifications requirements just because it is a government-backed mortgage. They may ask a few more questions, a few more verification of employment or different things to get it through. VA mortgages. These are for veterans and active military. There's no set minimum from the VA. However, most lenders will require at least a 620 credit score. Some can go as low as a 580, but there's a little bit of a VA themselves do not set the minimum. USDA mortgage loans. These are specific for buyers that are purchasing a home in rural areas. I know of quite a few different areas around Cedar Rapids that are included in that. So there's no set minimum credit score from the USDA. However, most lenders, again, will go with that 640. And then conventional. So these are your traditional mortgages, 15-year, 30-year. They will require anywhere from a 620 to a 640 credit score.
Reagan, I have another question here. Back to the qualifications for the rates. Someone is asking, I see that your collections must be paid, which is understandable, but I'm wondering if the lender needs to see receipts for payments of those collections, or can you give the money to the lender and have them pay the collections?
Good question. So I think it depends upon the type of mortgage that you are getting, in a sense, or pre-qualifying for. If it's a purchase, I believe they have to be paid prior to closing with proof of payment. So either you have something written as a receipt from the agency showing that it's paid. Sometimes they'll look at your checking account or savings account where it was pulled from to verify that that amount came out. Sometimes with a refinance, you can actually give the money that you want to pay at closing to the collection agency, and then your lender can take care of it and pay them directly. Good question.
Perfect, thank you.
Okay, so moving on to auto loans, you'll see some of these secrets of underwriting are going to be very similar to what they are for the mortgage side of things. Again, they look at that 740 credit score or higher, having 90% loan to value, so putting 10% into the vehicle at the time of purchase. Debt to income being 30% or lower. And then again, the time with your employer, the longer you've had the job, the more stability. And then your overall financial stability or character, your credit report, credit payment history. But again, like we did with the mortgages, you can still qualify for an auto loan even if you can't check all those boxes off. So credit score, there's no minimum that is set. So I always tell people to check with their financial institution. Many institutions will look at the relationship that you have with them and determine whether or not they will lend to you, with all the other criteria met. So I would say that there's no minimum credit score in order to qualify for an auto loan. Also, you can borrow up to 125% of the value of the vehicle. So maybe you have a trade-in, maybe you owe a little bit more than what the trade-in is worth. Sometimes that can make your loan to value percentage a little bit higher. So financials will allow for that wiggle room. Maybe you'd like to purchase a warranty or a gap protection plan that you want to add to the loan instead of paying that with cash. So that is why they allow for that up to 125% of the value. Debt to income percentage, that can also be 45% or lower. And then again, your time with current employer, the longer the better. And then your overall financial stability credit report is reviewed, in short.
Reagan, I have a question on that 125% of the loan value. If you borrow greater than 100%, will that impact your interest rate?
Yes. So borrowing more than what the vehicle is worth will increase the interest rate. So depending on how far how close you are to that 125%, it'll likely be a higher rate the closer you are to borrowing more than what the value is.
Perfect.
These are great questions. Thank you.
Very good. Oh, I have another one. I'll jump in here real quick since we have breathing space. When computing debt to income, will the lender take into account a married couple's income or only the individual?
Also good. It would depend upon how you are qualifying for the loan. So the only way that you can include both people's income is in the event that you're both going to be on the loan. Most of the time, they will not take into effect or consideration household income if only one of you is on the loan. And the reason being, if only one person is on that loan, only one person is required to make that payment.
Great, thank you.
Okay, so some of you may have been, I don't know, maybe you remember it back in 2018 when we started doing these lunch and learns. I did a little seminar on how to review and understand credit reports. It was shortly after the Equifax breach, and so I wanted to make sure that we got that information out. What I found was actually pretty interesting. I lost my notes here, but the average credit score in 2017 was a 695 in the United States. So when I take a look at this, I was always curious, like, okay, so I wonder where it's going. And then especially after last year, I was kind of concerned as to whether or not the average credit score went down or if it went up. Well, find out that it actually went up by 15 points. So in 2020, the average credit score of someone in the United States was a 710, and it had been a 695 in 2017. So this table actually breaks it down by age groups and what the average credit score is for that age group. So this is kind of interesting. You'll see, obviously, the older we get, the wiser we get because our scores go up. But you'll also, I think, take a look at that 18 to 23-year-old range. Their scores are going to be a little bit lower, but that's primarily going to be mostly because they don't have a lot of credit history. 18-year-olds, that's the first time that they can either apply for credit with a vehicle loan, or they can apply for a credit card, or maybe they have student loans, but they're deferred, so they're not making payments. All those go into reasons as to why their score might be a little bit lower. But I thought it was super interesting. And when Becky and I were putting together this presentation, she asked me, she's like, well, why do you think that is? Why do you think that the average credit score went up in 2020? And there was so much uncertainty last year that it was kind of astonishing me as to why the score went up. I think, though, it's primarily because there's so much more education around it. I think everywhere we go, we hear about what your credit score is. There's commercials on TV, boost your credit score. Credit card statements now have your FICO score included in it. I think it's just more awareness and being conscious of what our score is and how it impacts the different things that we do. So even though we had a lot of, high unemployment and loss of income last year, I think people still made a point to make their payments on time, which is kind of impressive.
Reagan, I have a question. What is the highest credit score possible?
850 is the highest. I think in the last 15, 16 years since I've been in the industry, I've seen as high as an 823. And I think anything right around that 740 or higher, that tier is really going to be, your A plus excellent credit score. But 850.
Thank you.
Yeah. Okay, so a little bit more about our credit score, and to give you all a break from my voice, I'm gonna just play this quick video. Becky, if you don't mind helping me with that.
You bet.
There are a lot of reasons you might want to check your credit reports. ConsumerFinance.gov has the info you need to help you understand your credit reports and scores. When people talk about their financial situation, they say they have good credit or bad credit. This usually refers to their credit history. Credit reporting companies compile information from your credit history into a credit report. The information in your credit reports may be used to make decisions about everything from employment to housing, and even the terms of your cell phone plan. That's why it's important to look at your reports each year to make sure your information is correct. You have the right to get a free credit report once a year from each of the 3 nationwide credit reporting companies. Getting your credit reports is easy. All you need to do is go to annualcreditreport.com and request your reports. If you need to receive additional credit reports, you can request more than one each year from the credit reporting companies for a fee that is capped by law. And there are some situations where you can get additional free reports during a year, like if you were denied credit because of information in your report, or if your report changes after you dispute an error. ConsumerFinance.gov is your go-to resource for clear answers to hundreds of financial questions. Learn more about how to request and review your credit report at consumerfinance.gov/credit.
All right, so I do recommend, if you haven't done this already, but to pull your credit report through that annualcreditreport.com site. You can also view all 3 of the bureaus, and I think that's important because not each reporting agency is the exact same. So you might find that maybe your credit card only reports to Equifax and doesn't report to TransUnion. So pulling all 3 is very important. The other thing to note too is you can actually pull now through the end of April weekly credit reports through annualcreditreport.com. So I would suggest, if there's anything that you're working on, maybe you want to pull it and see if there's any collection items out there, or see if anything that you need to dispute real quick. I suggest taking advantage of that free weekly credit report for the next, what do we have, like maybe 4 or 5 weeks. I don't know if they'll extend it out, but I think it's a great opportunity to see what you have out there. And if there's anything you need to do, this will be a great start. And by all means, if you do this and then you don't know what to do, call me. I'll help you. The other avenue out there to monitor your credit report is Credit Karma. I myself use this one. It's just a great user-friendly. It's on my phone. I can just download the app. It doesn't cost anything. Just be leery that there will be ads out there. They'll tell you what your credit score is. However, it's not accurate. It's about 30 points on average, either higher or lower than what it truly is. But I think it's a great tool that you have access to your credit history at the palm of your hands. So either one of those are great avenues. Okay, so if you want to raise your credit score, what do you want to do and how do we do it? So 35% of your credit score is made up of payment history. What I tell people to do is, set up the reoccurring minimum monthly payment for all your debt. So maybe your credit card payment's $27. So you want to pay $27 every month. Set it up so that it will pay that for you. Then you will know that you will never have a late payment and you will always pay enough that you need. However, you can pay that card anytime throughout the month and you can pay more on it. But setting up that reoccurring payment takes that kind of headache of managing when it's due away from you. 30% of your credit score is the amount of money that is owed. So take a look at your balance to limit ratios on your credit cards. Are you using a lot of the available credit to you that is available to you? So if you have your credit card again at $1,000, that magic number of 30% is $300. So if your credit card limits $1,000, to keep your score as high as possible, don't ever have a balance of over $300 on that. That's your magic number. 15% of your credit score is the length of credit history. So how long have you been borrowing? Again, the younger we are, the less history that we have. That's just a time thing. But some people get into borrowing money later in life as well. So that will all play a factor in it. 10% of our credit score is new credit. So don't open too many accounts too rapidly. The credit bureaus, when they determine your scores, will see how many times you're applying for credit and then also how many accounts are opened. So if you have three or four credit cards that you applied for in the month of, let's say, March, and then all those cards were opened in April, you've just asked for a whole lot of credit in a very short period of time. This will likely decrease your score. So don't open too many things too quickly. And then the last 10% is made up of the credit mixture. So this is the type of credit that you have. The more mix, the better the score. So you don't want to have all your debt be in credit cards. You don't want it to all be in installment loans or all of it in student loans. So having a good mix will help increase your credit score as well. All right, other ways to raise your score. So we talked a little bit about the collection accounts and the bankruptcies with the mortgage application. So again, you must have those collections paid prior to receiving the mortgage, and then no bankruptcies within the last 2 years. One note, or one thing to note on the collection accounts, if you want to start paying some of those off, definitely before you pay them, ask to make sure and see if they'll remove it from your credit report. I would say 9 times out of 10, they will. All you have to do is ask for it and then get the proof in writing. Raising your credit score, obviously making a minimum of 24 months of on-time payments going ahead, but then establishing that habit and continue to make your minimum monthly payments on time. And then limiting that balance, that magic number of 30%. The less you owe, the better, and the higher the score. Okay, so when you need or you want a loan, what should you do? What should we do as consumers? I just ask to do your research. Make sure that when you're seeing these big red advertised interest rates or reading them in the mail that you get, they're always sending offers, or seeing something on the TV or online. Just read the fine print. Find out what the requirements are for that rate. Maybe it's a really long-winded, small fine print and you can't read it. Pick up the phone and call and ask them. So when you are inquiring about a rate or possibility of getting a loan, ask the specifics. So what credit score do I need to get that rate? How much of a down payment do I need to get that rate? Knowing your specific situation will help, and don't hesitate to give that to the person that's on the other end of that phone. The reason I say that is if you just call and shop around to find out what mortgage rates are doing, you're going to get the as low as rate from the get-go. And they're going to say, our low as rate is 2.5%. But that's as low as, and just saying as low as it discloses that not everybody qualifies for that, but that doesn't mean that everybody gets that. So please know that. Okay, you've listened to me for 45 minutes and I appreciate it more than anything. I also appreciate feedback. So we're going to do a little quick survey at the end of this that will be emailed to you. So please, please, please don't hesitate to be honest. Tell me what you think. What do I need to work on? I want to continue doing these throughout the year before we can get back together again. So all the help is appreciated. Again, if you have questions, you have concerns, or you don't know what to do with all this information, call me, email me, anything. I'm here to help. And then if you have questions about, what do you need to ask when you call your financial institution, I'll help you. Just reach out. All right. Do we have any last minute questions before I let you all go?
I don't have anything in the hopper right now, Reagan, but if anybody has any questions and would like to unmute, you're welcome to. Otherwise, thanks so much for listening and attending and all the questions you sent. They were awesome.
Yes. Thank you all. Okay. Well, I will, adjourn our lunch and learn, our first lunch and learn of 2021. And I hope to see you all on the next one in a few months.